Hi there. Thank you so much for joining us today. We're so glad to see all of you logged in. My name is Kellie DeMarco, and this is our investments webinar of the 2021 forecast, Markets and Economy, post-COVID, post-elections, and post-recession, all brought to you by Goldenstone Wealth Management. Again, we're so happy that you're with us today. We've got a great program for the next hour, and we really want to provide this to you to learn some valuable information about what's happening in the marketplace as we start this new year, right? What's trending, and something I'm always thinking about, how to best invest my money amid this craziness of the pandemic that we're still in. So again, my name is Kellie DeMarco. I will be your moderator today. I am the president of Kellie DeMarco Communications, a media relations agency here in Sacramento that I started after being on the news for almost 20 years. And my job here, as far as moderating and helping you, is really to continue using my voice to help people like yourself. I help folks share their story with their clients. I help you with media relations. And of course, I always help you look your best on camera. And so I'm just honored again to work with a company like Goldenstone Wealth Management, because I love that they really help us better understand our finances and what is going on in the world around us. Because as you know, things that are happening really with trends, things that come up now post-pandemic and during pandemic is really going to affect the way that we invest our money. So we actually have two fantastic panelists that are joining us today. We have the CEO of Goldenstone and the Senior Product Strategist at BlackRock, which is the world's largest asset firm. So really great program. Let's pop up Chris and Sanjay so we can see your faces here. Chris DiPrimio is responsible for providing a link between investment teams and all client groups, and for providing insight on the active equities product platform. Prior to his current role, Chris was a member of BlackRock Alternative Specialist Group, where he served as a product specialist for alternative investment products offered to private wealth clients. Did I get that right, Chris?
It's perfect.
Okay, perfect. And I have to also mention that he started his career at Hamilton Lane Advisors, which is also a global private equity firm. So Chris, thank you for being with us today. And many of you on this webinar probably already know Sanjay Varshney, if he wants to pop himself up. Hey, Sanjay.
Hi. Hi, Kellie.
Great to see you both. Sanjay's a senior wealth management executive for several years at Wells Fargo Private Bank, and he led the investment strategy for over 200 billion in assets. He also served as the business school dean at Sacramento State, right down the road here, and still serves as professor of finance. So you guys are in good hands today. We got great information coming up. Before we get to you guys, I just want to get through a couple housekeeping items, and that is, we've got you all on mute just so that we can kind of manage this and you can hear the questions being asked and answered. But please, if you have any questions along the way, make sure to type those in the chat box. We're going to get to those if we can at the end. And most importantly, just know that this webinar is all about you and your investments. So we hope that you enjoy this experience. All right, so let's jump right in. We know 2020 was an interesting year, to say the least. A lot went wrong. But I think as we look forward to 2021, we've kicked off a lot of changes on the horizon here, some positive, some still negative. We have a vaccine, right? Hallelujah, we've got a vaccine. It's come with some challenges though, right? I mean, we've had some issues with folks getting the vaccines, having that rollout be kind of slow and frustrating. Elections are over. We're going to talk about that and this new administration. And then here in California, of course, we're dealing with a recall campaign underway for our governor. And then at the same time, small businesses still struggling. Here in Sacramento, we're in the purple tier, meaning we're not out of the woods yet. And our businesses are operating on just kind of a limited capacity right now. So with all that in mind, Sanjay, I want to start with you. Just kind of give us a status update on the economy and the markets as we start this year. I know you put like a big forecast together for us. Can you walk us through that a little bit?
Sure, Kellie, and good afternoon, everyone. So 2020 was a crazy year, and we're so glad to put it behind us. And 2021 is actually shaping up to be a fairly decent year. I'm calling it the year of the recovery and healing and a new bull market. We have a lot of tailwinds. that are helping us, so far. And then I'm going to also talk about some headwinds that we are beginning to face. And you can see, for example, the last week especially has been fairly volatile in the market. The January and February have not been easy. We've seen days when the market did well, and then there are days when actually the market has been not behaving very, very well. So going back to the tailwinds, we closed out 2020 on a very strong note, even though I know 2020 seemed like a really bad year in so many ways, especially when it comes to our own families. We were not able to get out and actually go out for dinner and be in a restaurant or travel and do all those wonderful things we were used to doing. But the market did well. The S&P 500 did 16%. NASDAQ did about 44%. So a very strong market. And then there were some other things going on in the background that caught our attention. We call it the year of the Bitcoin because Bitcoin was on fire last year, continues to make headlines this year. We're talking about SPACs. These are the special purpose acquisition companies. For example, Virgin Galactic is an example, where you have these blank check companies going public, and then you see some other companies doing a reverse merger into those. So 2020 turned out to be the year of Bitcoin, SPACs, and of course, IPOs. We saw DoorDash, we saw Airbnb amongst the big names that actually went public. In terms of economic growth, we actually had a very sharp recovery last year, V-shaped recovery in many ways. Unemployment claims continue to fall, and we have seen the rate come down substantially. In January, retail sales made headlines this year by going up 5%. So, the joke was, if you were the people who were not shopping during Christmas time actually showed up in January to do the Christmas, all the buying. Strong retail sales, consumer confidence has come back, business confidence has come back to a large extent. The manufacturing activity, the service sector activity, they're back to pre-pandemic levels. So those are all good indicators that our economy is healthy. The housing market has been very strong. Part of the reason being that we have had very low mortgage rates, and a lot of money that basically people did not spend on other things showed up in their pockets, and they are putting it down towards their home purchases. We have clearly seen a lot of stimulus on the table, both from the Federal Reserve as well as from Congress. My math shows that we have roughly $10 trillion that was thrown under the table between all the monetary policy and the fiscal policy, and we're still talking about another 1.9 trillion that Biden has put on the table right now for 2021, followed by maybe another 2 trillion in the latter part of the year. So a lot of money is being put on the table. Recovery has been great. K-shaped recovery where we have seen winners and losers. To a large extent, we've seen structural changes. So not all companies have basically won. Clearly, there are many companies that are still under pressure, have not been able to adapt, but and they have been under pressure from a pricing perspective. But clearly, the cloud-based companies that have been able to adapt are doing well. Earnings season is winding down, I guess. And we have seen almost 65% of the companies that have reported so far report better earnings than expected, almost more than one standard deviation than the expectation. And that's great news because that shows that the earnings are really strong and corporate America is becoming healthy again. Interest rates are low. Inflation is still very low. This is the first year of the bull market or the bull cycle that has emerged. And we saw a very short recession last year. So all in all, I think the tailwinds are really strong. And I think that has helped shape expectations for 2021 to be a good, strong year. Some headwinds. I want to quickly talk about those because obviously, we still have some challenges to work out. Vaccine rollout has been very slow. So you can see tourism and travel that thought they're going to basically just jump right back in the second half of the year. It's not happening. There's been glitches. Doses have been supplied, but somehow the vaccinations have not happened as fast as people expected. The biggest challenge we are seeing in the last week that I've seen in the markets is that the U.S. Treasury bond, the 10-year bond yield has basically crossed 1.4%. And that has caught people by surprise because A, It's making the equity markets less attractive. It's really having an impact on technology companies that are very sensitive to high rates. And in a way, there's fear that if the rates continue to rise here on the 10-year, for example, it's going to drag the mortgage rates up higher. And a 1% increase in the 10-year rate or the mortgage rate could result in almost a 12% loss in buying power, for the homeowners. So the housing market looks great right now, but there's caution on the horizon that, by the way, if rates continue to rise here, the housing market could actually suddenly see some major challenges in the latter part of 2021. Our deficit is huge. We're talking about in excess of $3 trillion, federal debt at 100% of GDP, roughly $15 trillion sitting worldwide with negative yields. I'm talking about countries like France, Germany. These bonds are basically negative yielding right now. And then another challenge that has shown up in the last few weeks is inflation expectations. The commodity markets are telling us that maybe inflation is going to spike from where we are right now. You can see, for example, silver, copper, lumber, all sitting at all-time highs right now, multi-year highs actually. And lumber has doubled in price. So clearly inflation is becoming a concern. Unemployment is still an issue as much as we think the rate has come down. There are a lot of people still displaced and out of a job. China has become stronger during this COVID crisis. And just more recently, when Biden said America is back, Europe just shrugged and said, great, but we have already moved on. And so clearly China is going to be an issue going forward. Last year, we saw the best days in the market and some of the worst days in the market in history. But history has also shown us that the best days and the worst days are usually followed by a very strong year in the 12 months afterwards. So we are positive, we are optimistic about 2021 for that reason as well. And then a lot of people are questioning, January was negative this year. So, and we have a saying, as goes January, so does the rest of the year. But in general, I think that has not always been true. So we are still optimistic that in spite of a very weak January, I think we are still going to see a strong 2021. And finally, I guess if you're asking us where our targets are for the year, we are still optimistic. Like I said, 2021, we expect the S&P 500 to about 4,300. That's a good 13 to 15% from where we are right now. The Fed funds rate is not going to move. Fed has already announced that they're going to stay where they are. The 10-year yield, even though we have crossed 1.4%, it might go up to 2%, but then I think when the dust settles, we'll probably be at about 1.5. Oil has already crossed 60, but I think when the supply expands again, as a result, you probably see oil fall back to about 55. Gold is going to go sideways. US dollar is going to probably get stronger. Our growth is very strong. We are predicting 5%, but I've seen street estimates as high as 8%. Wow. Unemployment rate should fall, and then the S&P earnings should really spike back to closer to 175 or 180. So I'm going to stop there, Kelly.
Yeah, it's interesting what you said about, January being the predictor. That certainly was not the case last year. I thought we were just rolling along fine in 2020, and then the pandemic happened. I like what you said too about housing, because I feel like here, definitely in Sacramento, it's just crazy the number of people that are moving from the Bay Area and just sweeping up all these homes. Great for if you're selling, but if you're competing with those folks here locally, that's getting more interesting. So a couple things kind of stick out to me as we head into this new year. Let's bring in Chris now from BlackRock. Again, we know that BlackRock is the largest firm with over $8 trillion, and many people who use exchange traded funds, Chris, are used to the iShares. But I know you've got a lot of special offerings that firms like Sanjay's get excited about. So talk about what you call systematic active equities, and what does that do for investors?
Yeah, absolutely. And thanks for the time today, Sanjay. Great update. By the way, from a market perspective, I think we would agree with a lot of observations that you are going into from 2021 out one perspective, especially looking at 2020. We'll highlight a little bit about how we were approaching 2020, which was a year unlike any other, given the amount of oscillations back and forth, the volatility of style dimension, the amount of rotations that you had. It almost seemed like we were in a what you would typically observe over a decade. You would see kind of in a week over week, day over day, month over month observation. One of the things that we've been built on from a systematic active equity perspective is we are viewed as one of the pioneers of quantitative equity management going back to 1985, actually based right there in the Bay Area. So we were a legacy Wells Fargo Nico, became a part of Barclays Global Investors. And then you mentioned, Kelly, the iShares brand. So when BlackRock acquired iShares in 2009, my group was actually a part of that transaction as well. And that's how we came into the fold within BlackRock. One of the unique aspects of how my group at Systematic Active Equity runs money is that we're always trying to strike this balance between investment philosophy and technology. And so you can imagine for 35 years being based in and around Silicon Valley, if you're trying to evolve and innovate through time, you would certainly be able to see that manifest over several iterations. And there is a slide, Sanjay, I don't know if you can pull up, that shows kind of what these evolutions have looked like through the third slide of my deck. But in 1985, I mean, innovation, quite frankly, which is almost humorous, is stack ranking the S&P 500 by a very generic value towards you're trying to find cheap relative to expensive stocks in the market. So you just screen by book to price and you trade. And that actually was how you outperformed in the market. If you think about the 90s, one of the best ways that you could have invested was what we call analyst sentiment. It was what we call guidance revision. So if you see the sell side community improving various earnings updates or declining earnings updates, you would just use that as a potential trade for 6 months. And in the U.S. large cap space, to put this in some perspective, you could be Disney Corporation. You have a guidance revision. You had 6 months to trade on that data, and you could still outperform the market. That was in the 90s. So one of the things that we ended up doing was realizing that data had become much wider than the company itself, right? And so every time you click your mouse, every time you look at your overall, you're on Facebook, you're on your cell phone, you're always creating a data point that gives us a better lens of how a company could be performing financially and fundamentally. And so if you go actually to slide 4 real quick, this idea of big data, I think is a little bit of a misnomer in the marketplace, which is folks associate data as this otherworldly, almost nebulous topic in the marketplace, when in reality, everything has become digitized. So it's just volumes of information. Within my group, we are processing 6,000 broker reports or sell-side reports a day. We're processing more than 5,000 company quarterly earnings calls as they're coming across. As soon as a news article hits from Bloomberg or Reuters or Ibbotson, we are intuiting that in real time as we can nowcast. The challenge with doing this is that you have to have the infrastructure in place with which to process the data. So the data is not the alpha. The alpha and the performance for our team actually comes from the infrastructure that we've built. And if you move forward to the next slide, I think the number one thing that we would say about, despite market evolutions, is that our process remains remarkably tethered to the underlying fundamentals of what is driving company performance. I had the privilege of a lifetime for actually presenting this topic to the D&I at the Pentagon. A couple of years ago, they were bringing in some private industry for a panel. So I was on stage in the Pentagon in front of 500 intelligence officers with somebody from AWS, and they were talking about lessons learned within these disciplines. And the number one thing that I tried to get across to the intelligence community was, if you use data in a vacuum, it can be very powerful, but also dangerous. In other words, if you start with a data set, it will tell you something, but will it tell you the right thing? The answer is probably not, right? It's probably gonna be spurious or random. What we care about within my group at SAE is causality. So as we go through some examples and we talk about some of the lessons learned in 2020, I think it's important to remember the themes on this slide, that we're harnessing this idea of alternative higher frequency data sets as a way to under company profits, investor behavior around the organization, which is what we call sentiment. And then finally, what macro dimensions may be impacting their overall business health and results long term. So, the harnessing of data, but keeping it tethered to economic rationale, that is the lesson learned. And it's led to some pretty interesting results as a result over the past decade.
I mean, there's so much information. Just I imagine your team, Chris, just looking through all this information. What kind of real specialized data are you looking at, and how did this really prepare you for what happened in 2020?
So it's actually a pretty interesting question. I think 2020 was a year where if you were trying to play catch up, you were going to get left behind. And so having the infrastructure in place allowed us to have some differentiated performance really in a period of mass uncertainty. Sanjay, if you go to the next slide, there is a quote from the CIO of my group. His name is Jeff Shen. He actually said this to a client that he and I were meeting with in 2019. And I put it in here because I think it's a very almost clairvoyant statement for what ended up happening in 2020. Alternative data is going to become the new oxygen in the investment process. That really became the name of the game during COVID. And so if you move to the next slide, we'll start to relay this to what was actually happening. So one of the best sources of information for company health that every investor will look at actually comes from the company themselves. And so you can imagine as you're listening to earnings calls, you're trying to clue into different markers of what they call guidance. Are they demonstrating any improvement or decline of their forward-looking business prospects? That can be both from a near-term absolute performance basis, also kind of long and intermediate term fundamentals. So they're going to give you that type of information. Same thing from the analyst community. And what we noticed in 2020 was that type of guidance update declined by 70%. So if you're trying to use guidance revisions and data like that, which every investor does, I don't care if you're systematic like us, and I don't care if you're a fundamental strategist where you are three people in a room listening to a conference call of an executive, you're trying to clue in to this type of information to make a decision. Last year, they weren't giving it to you. The old adage used to be, we have boots on the ground. We have a 22-hour trading day. Sanjay has heard every asset management firm in the world say that as they talk to him about different capabilities. That's great. Everybody's boots have been in the closet for the past 12 months. So if the data is stopping, what are you doing with which to make a decision? And this is where alternative data actually became a better way to intuit what was happening. It was higher frequency. So if you go to the next slide, it gives us a little bit of an idea. Now, as alarming as this view may be, this is not actual viral spread in the States, so please just bear with me with the visual. This is actually a measurement of what we call geolocation. So we get cellular information. It's all anonymized, so we're not getting, there's no Chris DiPrimios running around in any of my team's systems. But what we are getting is this very dirty, very raw data that is identifying a latitude and longitude coordinate alongside an observation, i.e. number of cell phone pings, for where overall cellular traffic actually is. What you see on this slide is for McDonald's restaurants, right? It's the clustering of people walking into McDonald's at a point in time. You can see in the Midwest, SAE stands for Systematic Active Equity. It is not Sigma Alpha Epsilon. Within this business, we love to give everybody acronyms. I apologize in advance. If you hear SAE, it's Systematic Active Equity. If you look at the Midwest, not a lot of McDonald's. West Coast, kind of more clustered than you would expect given In-N-Out Burger. But certainly you're seeing a huge prominence of people walking in and out of McDonald's. Now, I bring this up because it's a very powerful tool to capture in real time. There was a storied investor. His name is Peter Lynch. Peter Lynch was a fundamental investor. He used to look at things like people walking out of Abercrombie and Fitch with a bag, and he would say, wow, it looks like they're selling something at that store, and would invest. This is a very similar concept, except we don't have a data error. You know, you're capturing the trend in real time. If you are predicting at today an increase in foot traffic relative to the same point in time last year, which allows you to negate for seasonality effects, well, now you have an early prediction of same-store sales growth. It's a way to capture organic revenues of a company. You're just doing it across all companies in real time. Now, if you go to the next slide, here's the challenge. We were all under state-mandated house arrest. In fact, I think I leave my house once a week. And encouragingly, to Sanjay's point up front about things getting better, AngelSoft is actually back in my grocery store, which had been pretty much what we would call like the gold of Fort Knox for the majority of 2020.
Yeah.
So this green line that you see is the drop off in foot traffic. Unsurprisingly, right? If you're trying to clue into how a company is performing, and foot traffic is dropping off because we're not traveling anywhere, how are you trying to, or how are you capable of measuring this? Well, we can triangulate it. And some of the things that we looked at in real time, we're looking at things like credit card transaction data. Once again, it sounds like that's a great data set. It's extraordinarily dirty. You can almost imagine every business having different initials, different acronyms, different ways of recording their business. If it's a Taco Bell, is it Yum Brands, or is it the franchisee that's kind of marking the overall credit card report? So you have to build this incredible mapping mechanism, which we had built before 2020. And so as the world is evolving, we're able to capture in real time the flow of capital for overall retail consumers. So last year, some of the trades that we were capturing, Tractor Supply Company, Overstock.com, Big Lots, people are going into what we call nesting mode. If you're not traveling, if you're not going to restaurants, you start to improve the current surroundings that you're living in. We were capturing a restaurant called Wingstop, which I've actually never been to, but we were able to see that more people were spending time on the mobile application for Wingstop, more people on the app for a greater duration of time. Pretty good way to forecast company revenues. We were underweight tailored brands. This is probably the first time I've worn a jacket in quite a bit of time, given that we're working from home. So, tailored brands, always a questionable business, buying one suit, getting 5 for free at Joseph A. Banks. But nobody's buying a suit in 2020, right? And so Lululemon, athleisure, all of these things are very logical trades. The difference is analysts aren't giving you the information because they don't really see what's happening on the ground. You've never had an outright economic shock like this. We're capturing it in real time. I think one of the better examples that we can provide is Urban Outfitters, which is on the next slide, which compliance had me change to quote unquote ghost town store. So this is Urban Outfitters. And to put this in perspective, the sell side community in midpoint of last year, the analyst was walking around Midtown Manhattan. And in Midtown Manhattan, what you noticed was after some of the protests in summer, Urban Outfitters store had plywood in front of the windows. So the analyst is peeking around the plywood, trying to say, are people actually in the store or not? And came out with this pretty scathing report that it's a ghost town store, they're not going to meet earnings. We had a different view on my team. Why? One is we saw more mobile app utilization, so more people are on the app, which is a good predictor of sales. We saw that credit card spending had actually bounced off the lows from April and May, so you're seeing that recovery at a business level. You actually saw a recovery in foot traffic as well, which is the green line. Now, what's important is that you're not capturing it just in Midtown, you're capturing that across the board. And then finally, online activity for the organization was actually remaining elevated from where it was earlier in 2020. So we start getting this image that the company's performance is going to be better than what the sell side community is trying to extrapolate. Lo and behold, we had an overweight position to the stock beats on earnings. And this gives you an idea of that triangulation in real time in a period of max uncertainty. The final thing that I'll mention as it comes to 2020 is this idea of mobility became uniquely correlated to overall economic activity. And so if you go to the next slide, the final thing that I'll leave you with for observations for 2020, you can imagine if you have anything electronic related and you carry it on your person, in some way, shape, or form, it is being tracked and aggregated. Once again, we're not looking for anybody individually, but we do care about, are there cars on the road? Is transit picking up from a logistics perspective? So are you seeing kind of the shipping happening? Are you seeing it from even marine shipping? We will look at kind of the global shipping lines. Mobility equals activity. So if you see the recovery in mobility, if you start to see that happen, the green shoots for the recovery pick up quite well. You see it correlated to both a services and a manufacturing PMI perspective. From our standpoint, this has given us a very unique way of intuiting what's going on at a macro dimension. Once again, people are trying to figure out, does the economy come back quickly? Does it take a while? It comes back quickly. It's all keyed in on mobility and things that we're tracking. So once again, if you're trying to play catch up in 2020, difficult time, we were uniquely prepared, I would say, for the virtual world starting to take over the physical world, given the COVID pandemic.
Yeah, I think we just kind of push our foot on the gas on that. And I'm glad you do not have any graphs of like the Amazon deliveries coming to my house. I would just be like a red spot. I imagine it's easy to track, or just in your mind think, okay, well, we're all ordering, from Grubhub or DoorDash or Amazon, but the way that you're tracking things is really exceptional, especially including what happened in 2020, where, yeah, you're not seeing all the same foot traffic and we're all just, huddled in homes. So, Chris, I'm just really curious, as this kind of all evolves and we're looking in this new year, how are you using technology now to kind of better understand how our, day-to-day operations have changed?
Interesting. We are, the entire fabric of our team is trying to understand where that data edge, where that advantage is manifesting, so that we can look at driving relative outperformance. And if you go back to slide 3, Sanjay, there's 2 key areas that we see the opportunity. One is sustainability, which is certainly a hot topic in the markets right now, and certainly from a societal perspective. New administration in the White House is starting to move towards, more of what we call kind of a Green Deal, looking more at the transition of the economy towards a low carbon future. From our standpoint, that is a tremendous alpha opportunity. So all of our portfolios are theoretically ESG integrated and ESG aware. What we've started to realize is that this is a space that has no concrete solution or view in the market. It allows us to generate some very unique return profiles through time. So ESG is probably the number one thing we're most excited about. I'll give you a quick example of how we kind of evaluate this. One is looking at employee sentiment for organizations. By the way, the research for this goes back to Maslow. So if everybody remembers their Psych 101 class and the hierarchy of needs, it's all about self-actualization, right? The happier you are, the better you work. And so for decades, financial managers have looked at smiling faces on assembly line floors. Not sure you're going to get any. I don't know if anybody remembers Sally Fields and Norma Ray, but that was a thing. And so there's a better way to get that information because they're giving it to us today. The way they're doing that is things like Glassdoor.com, right? So we can get this anonymous view of an employee on the culture and view towards management of their business. If you see those views improve or decline through time, it is a very unique predictor. Now, this is a social dimension. It's a ESG theoretical insight, but it's very closely tied to the financial performance of the firm. And our research has shown it's a good predictor of 12 months out for performance. So, there's something to ESG. There's an alpha component there. I think a lot of folks view it as risk. It's not, it is alpha. So we are pushing out in that space pretty meaningfully. And the other that I'll bring up, which Sanjay alluded to in his outlook, is China. So China strategies are something that we see more and more institutionally, something that we manage the China strategies, by the way, for the World Bank and the IMF and the UN. So my team is kind of very well known in that space, but it is without doubt the active manager's playground. And the reason being is that information is very difficult to obtain. And if there's one overarching theme for how my team runs money and where you see success, is that whenever data is difficult to acquire or relatively diffuse in the market, and you can go into that space with speed and creativity and accuracy, you do get an ability to outperform in that respective market. So I think the 2 areas we're most excited about, probably sustainability as well as China A.
Great information. So neat how you take all this information, and gosh, you just really had to turn some of these strategies upside down after what happened last year. So Sanjay, I'm glad you're back in here because, you get all this information here, right? How do you turn this into now investing the right way and making money for your clients? I mean, it's a fun game, right?
So I think, Chris, by the way, that was a great presentation on how data can be used. We never think about data being used in that sense, where we're talking about big data, machine reading, artificial intelligence, robotics being the future. So given all that, all that presentation, I guess, that Chris just made, this is a market where clearly a lot of people are concerned, given the market has been going up. After the crash we saw last year in March, if you panicked and you sold at that time and never went back in, clearly you missed a ride. The question is, can we expect the market to continue its ride upwards from where we are? given that we clearly have had a spectacular last 12 months, 9 months, especially in the markets. So if you look at worldwide, globally, the valuations look stretched. So based on the 10-year average price to earnings ratios that we have seen historically, if you look at the United States, you look at Denmark, Netherlands, you look at India, you look at China, it doesn't matter where you look in the world, looks like the world stock markets came back last year, and they all look overpriced based on historical trends or historical PE ratios. And obviously the concern is legit that, by the way, truly, are we seeing a bubble here, especially with SPACs and the IPOs that went out last year and Bitcoin on the kind of wild, sort of scene, or is this sustainable? And so I'm going to share some data with you, which probably will instill some confidence that much contrary to what people think about what happened last year, more money flowed out of the stock market than actually flowed in. So as much as we think that the stock market has been on fire and a lot of money has been pouring into the stock market, quite to the contrary, last year, actually, we saw a negative, number for the net flows. And so was the case for 2019. And history has shown that when that happens, usually you can expect to see another good, solid 12-month of performance afterwards. So we do expect 2021 to be strong just based on the fact that last year we had negative inflows into the stock market. Where is all that money going, by the way? So if you're wondering, hey, by the way, if you have net negative inflows into the stock market, people actually are sitting on the sidelines to a large extent. You look at the money market funds, we have $5 trillion sitting right now in money market funds, waiting to be invested. And remember, a lot of people did not go back into the market last year after they bailed out in March because they just panicked. They thought the world was coming to an end, and with the pandemic and everything else and all the hype and the media, whatever you saw on television made you extremely pessimistic about the world. And again, when you have that kind of cash sitting on the sidelines, and by the way, there's $1.5 trillion additional personal income increase in pockets of people in the United States. So I understand that a lot of people are without a job right now and they've been displaced, but there's a lot of other people who actually do have extra money now because they didn't spend it last year on hospitality and leisure. So that is going to be helpful. People were worried about the elections, and we've already said this before. Elections matter a little bit, but once the uncertainty goes away, markets just plow on. So right now we know exactly who's in office. They're in charge of all the three forms of government, right? And so I think they're going to just plow on here. And so that's another positive thing in the markets. One of the things that's happening though in the background that we have not seen obvious is that there's a huge rotation going on in the markets. So for the last several years, it was a growth-driven market. More recently, we have seen value kind of stocks actually come into play, and a lot of money is moving out from the growth areas into the value areas. And you can see, for example, this is a scary chart on the screen. If you guys can see how the chart panned out, the post-World War II era, for the longest time, value outperformed growth. And once again, we are back to the same scenario as the post-World War II, where our debt, federal debt, is at 100% of GDP. Rates are at rock bottom zero. We're expecting a similar boom in the economy, just like the post-World War II era that we saw in terms of construction, infrastructure spending, in terms of production. And so the chances are that we will see this broadening out in the market. And it's not only going to be about the tech stocks only, it's going to be about some value plays as well. And if I can see technology do okay and the rest of the market broaden out, that's a great place to be. That shows that we're able to sustain a very broad strength in the market. The other thing that's going on is that if you have been in the market the last few months and you haven't noticed, the last 2 months especially have been extremely strong for small caps and mid caps. In fact, small caps have outperformed the large caps by almost 25% in the last couple of months. And they continue to do that even now. So you can see, for example, small caps are still strong. And as the economy rebounds in the United States, small caps tend to do better. So at our firm, Andres and I obviously are paying very close attention to rotating the money out from the large caps that we were used to last year, and putting a little bit more emphasis on the small caps and the mid caps. In general, we still like technology. So don't get me wrong. We still like technology because that's a growth story. We still like financials. We like healthcare. Financials have had a strong run in the last 3 or 4 months. And I think given the current environment, we'll probably see financials do okay going forward. We like industrials now because with infrastructure spending, you will see to a large extent, industrials get a good play. Materials will get a good play. We're just staying away from the consumer staples. We're staying away from utilities. We're staying away from real estate. To some extent, consumer discretionary cyclicals are going to see a strong, a run up because as the economy comes back, I'm sure those stocks are going to basically benefit. So all in all, I think we are still, very optimistic about the kind of growth opportunities we see in the market, in the different sectors, in the different areas. I thought I would share this chart with everybody because if you're well diversified, typically when the market is doing well, when the S&P 500 is doing well, you may not do as well. And you might say, you know what, I'm not making as much money. When the market's not doing well, typically you lose money too. Doesn't matter, even if you're diversified. And you say, oh my God, I lost money. So generally, if you're well diversified, you tend to basically have that feeling, hey, maybe I did not do as well. But if you look at this chart, you'll see that actually you come out farther ahead compared to the S&P 500. So if you're well diversified, you will do well in the long run. Yeah, and you just have to be patient, I guess. And patience is a huge virtue in our world.
Or find another GameStop, and let's talk about that. We can't let you go without talking about that. I mean, so all of this is really interesting of just what you think, folks should be investing their money in at this point. Things like housing, that's probably just in kind of a weird spot right now, not the place to be. So just talk about, trading versus investing. Like, where are we at this point forward? What should we really start to look at this year?
So, we've had a very strong stock market, and I think we're going to see continued strength in the stock market. So I still like the stock market over the bond market. Okay. Because as the yields go up, as the 10-year goes up, it is going to put pressure on the bond market in many ways. You will see, valuations in the bond sector come down quite a bit, and people will see some losses on their principal. We like the rest of the world. Actually, after a long time, emerging markets look great. If you go to China, you go to India, as much as I know, right now we are still worried about China and its strength, but there are opportunities in the emerging markets that are coming back into play because for the longest time, emerging markets actually did not do well. So now, once again, you can see we are putting an overweight on emerging markets. We like South Korea, we like Singapore, we like Thailand, Vietnam. So there are some pockets all over the world that are going to show stronger strength, in terms of the growth going forward. But United States is still very strong. I prefer United States over Europe because Europe, as much as we think is getting stronger, actually quite to the contrary. I think they still have a lot of weakness, and with all the shutdowns and everything else, especially in the UK, for example, you can see flights from the UK are still banned to many different countries. Mm-hmm. The last few weeks, Kelly, you asked me about the trading market, the GameStop and all those things. The retail investor, remember, has been sitting at home, working from home to a large extent with more money in their pockets, either directly or through stimulus that came into their pockets. It's a younger generation. If you're not able to go out and do other things, you will spend your time on something else. So we have seen a lot of active trading. Retail investor trading has gone up 60% in the last 1 year compared to where we used to be. And so when we see the spikes in the prices of GameStop or AMC or the price of silver or the price of wheat stocks because Reddit is basically hyping them up, or some other groups are forming some other social media kind of groups. So we will see some of that continue going forward. But it's a wake-up call for all of us. We want to make sure that we are investing, in a disciplined way. We are basically behaving in a way that basically makes sense. Investor behavior has a large part to do with whether or not you're successful or you're not successful. A lot of people who think they're smart, they can trade actively, they actually make a lot many more errors compared to a more disciplined buy and hold strategy over long horizons. Here's a nice chart that shows you, for example, what happens to your portfolio if you miss the one best day in the market, or the two best days, or the 20 best days in the market. In a year where we have 250 trading days, if you miss 20 of those, right, somewhere, your portfolio basically shrinks by more than 2/3. So the question is, how do you know which days can you predict that going forward, that, by the way, let me not miss these 20 days. I'm going to stay invested in those 20 days, and the rest of the year I can basically be out of the market. You can't. So you got to be a little bit more disciplined about that. We have a saying, time in the market is more critical than how much money you put in the market. Mm. The longer you stay invested, the power of compounding comes out in your favor, and that's where you need to be. And that's where discipline comes in. You have to play the market well. And I guess, like I said, a lot of people who traded very actively are not basically getting the returns they should.
Yeah.
So I'm going to stop there, Kelly, and see if there are any questions or any other comments, from our audience.
Yeah, and let's bring Chris back in too. And again, want to let our audience know if you have any questions before we end the hour here. We've got a few minutes left. If you want to jump in the chat, want to ask anything, or maybe go back with anything. And Chris, if you want to turn your camera on, come back in. Yeah, I do think it's interesting what you were just mentioning too. It's kind of, that's why we hire guys like you, is because, we're working, we're busy, and it's very easy to miss out on those little opportunities if you're not, paying attention to it every day. I think with all of us kind of, huddled down for work, we've started little kind of side business, side gig things. But in the long run, especially if you're looking at investing a lot, not having some, little account, we need you guys for some of these trends. I'm curious, you both mentioned China, and, if our audience is thinking about investing in some of these emerging markets like China, like India, Chris, I'm curious what you think too. How do they actually invest in those? Like, what's the best process to get that going?
There's a couple things I would say. One is, I'm going to say this through the lens of an active manager, which is an active approach to the space to deliver some outperformance. It seems to make sense. I mean, when there are markets where you can get what is called durable alpha, in other words, there is a consistency to the ability to outperform that market, it's hard enough to do. Why take an empathetic approach? And so to me, emerging markets are especially useful with which to get some outperformance. China is probably the more interesting of any of the emerging markets, because you have to question, is it actually emerging still, or is it developed? It is the second largest economy in the world. Yeah. It is the second most liquid stock market in the world. And I think people don't fully appreciate that aspect of it. The stock market there is more liquid than all of Europe and more liquid than Japan. And so the way that most of our investors are actually starting to approach the space is what we call GEM X China, and then they do China A. So essentially what they're doing is a global emerging market portfolio where they carve out the China exposure. So it's all EM outside of China, and then they allocate to China A specifically. And China A shares is the local China economy. People are in this country a little afraid of that given headline risk. They view it as state-owned enterprises, and that there's some regulatory hurdles that you have to get past. In 2000, I would say that's probably true, where 75% of the organizations were state-owned enterprises. Today, it's only about 25%. And all of the newcos in that China economy, it's discretionary companies, it's retail, it's internet, it's healthcare, it's the technology and the growth of the consumer in China. And to leave you with a little bit of a pebble in the shoe, so to speak, for why this is a unique opportunity, just to compare and contrast to the US. In the US, you only have about 25 million people that have yet in this country to get online with a degree of consistency. In China, that number is about 750 million. So I don't know, my math isn't too good, but I think I take the 750 over the 25 as a unique consumer opportunity. And the other thing that we would say is if you compare the globe along the ideas of you have an economic stack, a political stack, and a technology stack, there are two dominant players in the world. It's the US and it's China, and there will be friction. There is a polarization. We are taking a firm stance as a country from a trade and protectionist standpoint. However, undoubtedly, everybody in this country only owns one of those two stacks. And so our view is that going forward, China A is going to become one of the bigger parts of all of our allocations. We think that the space is going to continue to evolve, similar to how Japan was viewed in the 80s, where it was US and Japan and rest of world. We think going forward, it's going to be US and China and rest of world from an investment perspective. And if you look at it from how indices, so benchmark providers, are looking at this overall, if they were to fully include China A, which is going to happen over the next 5 to 10 years, if you listen to MSCI and FTSE, 40% of the index, of the entire global EM index, 40% would be China. So just to put that in perspective, if you're making an emerging market play, you are really making a play on China. And from our perspective, it makes sense to carve that out and to get some outperformance.
Sanjay, you just got back from India and you said, things are just really taking off there too.
Absolutely. So the other growth story besides China is India. And India, in a way, I think has stronger growth prospects in the economy because of the kind of hit they took last year. A couple of reasons. One, they have the youngest labor force in the world. So while China still faces an aging population, as does the United States, as does Europe, as does Japan, as does half the world, more than half the world. But India somehow is in a sweet spot where half the labor force, believe it or not, is under 25 years of age. And so it's a very young country in terms of population. The 65 plus population is right now in a small minority. So in terms of just the productivity and in terms of the opportunities, in terms of growth, you're probably going to see a very strong opportunity in India going forward. The second, I guess, is the political, which is the Modi government, which has now been there for a few years, has been very pro-growth and very, very pro-business. And if they can survive the attempts to bring them down, because obviously in a democracy that's dysfunctional like India, you'll always see the opposition parties basically trying to destabilize the current government. But if Modi can survive, and he's already taken huge bets, right, from the demonetization in India, wiping out 90% of the currency that was basically black money, to forcing everybody to have the equivalent of a social security number. And everybody basically now has biometrics on record. So whether it's their thumbprint or their eyes. So a lot of the black money and all that, parallel economy basically in India is shrinking. So I'm optimistic. Like I said, China is obviously a growth story. If I just draw a circle around India and China, half the world's population lives in that circle, and 30% of that circle basically calls themselves middle class. And like Chris was pointing out, those numbers are staggering. We're talking about a couple of billion people compared to the 330 million people we have in the United States.
Really good stuff, you guys. Thank you so much. And again, I always feel like when I leave conversations with you, Sanjay, I always feel certainly optimistic. We know that there's going to be some winners and losers in this new year, but we're glad that we have you in our corner. Chris, thank you so much for joining us from Pennsylvania and giving us just a little peek inside what you do and what you offer in your financial expertise. Just want to let you know that if you want to watch this webinar later or share it, we're going to be recording that. And if you have any questions that come up for any one of us, feel free to email us. We're going to get you our contact information here. So we're easy to get a hold of. If there's something that maybe you're kind of chewing on later and thought, gosh, I should have asked Sanjay this. Easy. Here's our email addresses. Let us know. And as always, just good luck this year. And we welcome any questions that you have regarding, investments, low-cost 401k plans, and just overall how to be a winner in these financial markets. So have a wonderful day. Chris, Sanjay, take care. We'll talk to you soon.